Ang isa sa pinakaimportanteng aspeto ng pagtatayo ng negosyo ay ang tamang pagpaplano at paghawak ng pananalapi o finances. Ngayon ay tatalakayin namin ang paksang Creating a Successful Financial Plan. O paano nga ba gumawa ng isang successful financial plan? So bilang entrepreneur o negosyante, ang pagkakaroon ng maayos na plano sa pananalapi ay isang mahalagang hakbang para sa sinumang negosyante, lalo na sa larangan ng turismo. Ito ay nagsisilbing gabay upang matiyak na tama ang paghawak ng pera. May iwasan ng labis na gastos at mapaghahandaan ang mga posibleng suliranin sa hinaharap. Sa pamamagitan nito, mas magiging handa ang isang negosyo sa mga hindi inaasang pangyayari, tulad ng kalamidad o krisis. So narito ang mga ilang bagay na dapat mong malaman sa paggawa ng financial plan. A. Sources of finance. Dito naman kung saan ka nga ba kukuha ng pondo para sa iyong negosyo. May iba't ibang paraan kung saan pwedeng kumuha ng pondo ang isang negosyante. Una na rito ang mga bangko o banks. Nagpapautang ng puhunan pero may interes. Halimbawa, kung kukuha ka ng 100,000 na loan, babayaran mo ito ng may dagdag na interes sa loob ng ilang buwan o taon. Ikalawa, venture capital. Mga investor na handang magbigay ng malaking halaga kapalit ng parte ng negosyo mo. Halimbawa, kung may innovative kang business idea, pwedeng may venture capitalist na mamuhunan. Ikatlo, rent to own or lease. Ito naman ay para sa kagamitan tulad ng makina o sasakyan. Halimbawa, imbis na bumili agad ng delivery van, pwede mo itong hulugan. Kumbaga ito ay hulugan. Ikapat, the supplier credit. Pwede kang kumuha ng stocks o supplies kahit hindi pa bayad agad, tapos babayaran ito sa due date. Ikalima, grants. Libreng pondo mula sa gobyerno, NGOs. Halimbawa na lang dito ang DTI o DOST ay may mga programa na nagbibigay ng grant sa mga small businesses. Ika-anim, inner circle. Ito ang hiram sa pamilya, kamag-anak o kaibigan, mas madaling kausap at walang masyadong requirements. Ikawalo, bootstrapping. Gamit ang sariling ipon, maliit na loan o credit card, karaniwan ito sa mga nagsisimula pa lang na negosyo. B. Financial management. Ang financial management ay isang proseso ng tamang paghawak ng kita at gastos. Kapag hindi ito na-manage ng maayos, maaaring maubusan ng cash ang negosyo at tuluyang magsara. Halimbawa na lang dito, kung hindi mo na budget ang puhunan, baka mapunta lahat sa supplies pero wala nang natira para sa renta o pasahod. Kaya mahalaga ang planning, record keeping at regular na pagsusuri sa financial status ng iyong negosyo. C. Basic Financial Management. Ito ang mga pangunahing dokumentong ginagamit upang masuri ang kabuuang kalagayan at pagganap ng isang negosyo sa aspeto ng pananalapi. Kabilang dito ang income statement o ang kita at gastusin, balance sheet, ari-arian, utang at kapital, at cash flow statement, daloy ng pera papasok at palabas ng negosyo. Mahalaga ang mga ito dahil nagbibigay ito ng malinaw na larawan kung gaano nga ba ka-stable at ka-sustainable ang isang negosyo. Ginagamit ito hindi lamang para sa internal na pagsusuri ng may-ari kundi maging sa pag-uulat ng mga investors, creditors at iba pang stakeholders. Sa tulong ng mga basic financial statements, mas madaling makagawa ng tamang desisyon para sa kauunlad ng isang negosyo.
So good day everyone. Today we will explore the essential financial documents, which is the income statement, balance sheet, cash flow statement, owner's equity, and the cash budget. Kung ikaw man ay isang business owner, student, or financial enthusiast, these tools are fundamental for evaluating performance, planning for growth, and making informed financial decisions. So, financial statement is nag-o-offer siya ng structured view of a company's financial condition. Napaka-critical niya for evaluating a business performance, attracting investors, obtaining loans, and ensuring financial sustainability. Meron siyang three core statement, which is income statement, balance sheet, and cash flow statement. Each provide unique insights into different aspects of the business, which is profitability, stability, and liquidity. We come now into income statement. So yung income statement, also called as profit and loss statement, is shows how much profit a companies generate over a specific period. Nagsisimula ito with the total revenue, subtracts the cost of goods sold to arrive at gross profit, and then deducts operating expenses, interest, and taxes to determine net income. So, itong statement na to, sinasagot niya yung tanong na, is the business making a profit or running at a loss? So, the balance sheet provides a snapshot of a company's financial position at a specific point in time. It lists assets, what the business owns, liabilities, what it owns, and equity, the owner's residential interest. So, equation nito is assets equals liabilities plus owner's equity. Napaka-powerful tool ito for assessing solvency, financial health, and how efficiently resources are managed. Next is cash flow statement overview. So the cash flow statement outlines how cash is generated and used during a given period. Divided into ito sa three section, which is yung una sa yung operating activities. So yung operating activities, ito yung cash generated from primary business function. Next is yung investing activities. Ito naman is cash spent on or received from long-term investments and assets. And lastly is the financing activities, which is cash flows from borrowing, repaying debt, or issuing equity. So, itong statement nito is napaka-essential niya for assessing liquidity, cash management, and the company's ability to fund operations and growth. So we come now sa sample cash flow computation. So here's the simple cash flow example. So sa net cash from operating activities, we have 95,000, and sa net cash used in investing activities naman, we have 200,000. So, dito naman sa net cash from financing activities, we have 130,000, and the net change in cash for the period is 25,000. So, this demonstrates how business may sustain cash reserves even when capital expenditures are high through strategic financing or strong operational performance. So we come now sa owner's equity. So owner's equity represents the owner's claim on the assets after liabilities are paid. It includes essential investments, additional capital contributions, and retained earnings. So while yung mga owners is nagbe-benefit from equity, they are paid last during liquidation, creditors come first. A strong equity position reflects retained profits and reinvestment, which indicate long-term financial stability. So, we come now sa cash management essentials. So, effective cash management essentials, ini-ensure nito na yung mga business has enough cash to meet short-term expenses and obligations. It involves monitoring inflows and outflows, maintaining sufficient reserves, and timing expenditures wisely. So, kapag poor naman yung cash management, nag-lead naman ito to liquidity problems. Even profitable businesses can fail without enough accessible cash. So, we come now sa cash budget importance. So, a cash budget is a financial plan that essentials future cash inflows and outflows over a specific period. Nakakatulong ito sa mga businesses to anticipate cash shortages or surpluses, allowing for proactive decision making by forecasting cash needs. Business can time borrowing, investments, and operational spending to maintain liquidity and achieve strategic goals. Lastly, is the sample balance sheet or daily brand enterprises. So this sample balance sheet tracks the growth of Daily Bread Enterprises over 3 years. Total assets rose from 965,000 in year 1 to 2,895 in year 3, indicating business expansion, increase in cash receivables, and inventory reflect growth in operations. Meanwhile, your rising equity shows that the business is becoming more financially self-reliant and profitable. So that's all for my part. Thank you so much for listening. I hope you guys understand.
We will come now to the ratio analysis and interpreting financial ratio. Business plans are evaluated for their financial feasibility, not only through financial statements, but also through the financial ratios. Financial ratios are used to facilitate comparisons between figures and help standardize the numbers. Ratio analysis is used to determine the different characteristics of the business such as liquidity, solvency, profitability, and others. So, ratio analysis is a key to financial analysis used to evaluate the company's financial performance and position. It simplifies large financial data and makes it easier to compare different businesses or analyze trends over time. Next is liquidity ratio. This ratio reflects the ability of the business to pay its due debts. The formula was current ratio equals current assets plus current liabilities. Quick ratio is equals to current assets minus inventories plus current liabilities. For example, a sari-sari store has current assets of 100,000, inventory was 20,000, current liabilities is 50,000. So the current ratio is equals to 100,000 plus 50,000 equals 150,000. Quick ratio is equals to 100,000 minus 20,000 plus 50,000 is equals to 130,000. Solvency ratio. These ratios measures the long-term liabilities of a business. It determines the long-term risk and it's of particular interest to investors and stockholders. The formula was debt ratio equals to total debt divided by total assets. For example, a local business has total debt of 500,000 and the total asset was 1 million. So debt ratio is equals to 500,000 divided by 1 million is equal to 0.5 or 50%, meaning half of the business is financed through loans, which is considered as a moderate level of risk. Profitability ratio. This kind of ratio reflects the company's profitability in relation to its assets. It measures the ability of the business to earn profit in relation to its experience. The formulas was return on assets equals operating profits divided by total assets. Profit margin equals to profit divided by sales. Return on equity equals net profit divided by owner's equity. For example, operating profit is 100,000, total assets 500,000, sales is equal to 250,000, profit 50,000, owner's equity 300,000, net profit 6,000. So the return on asset is equals to 100,000 divided by 500,000 equals 0.2 or 20%. Profit margin is equals to 50,000 divided by 250,000 equals to 0.2 or 20%. The return on equity is equals to 60,000 divided by 300,000 equals 0.2 or 20%, meaning the business earns 0.20 pesos for every 1 peso investment in assets or equity. Efficiency ratio are assets and debt management ratios. These ratios determine the right mix between assets versus sales and debt against equity. It measures the performance of the business in terms of utilizing its assets and liabilities to generate sales and earn profits. The formulas was asset turnover ratio equals to total sales divided by beginning assets plus ending assets divided by 2. Inventory turnover ratio equals to net sales divided by inventory. For example, total sales is 500,000, beginning assets is 200,000, ending assets is 300,000, inventory was 50,000. Average assets is equals to 200,000 plus 300,000 divided by 2 is equals to 250,000. Asset turnover ratio is equals to 500,000 divided by 250,000 equals 2. Inventory turnover ratio is equals to 500,000 divided by 50,000 equals 10, meaning the business earns 2 in sales for every 1 peso in assets and sells out its inventory 10 times in a year. Market value ratio, also called market prospect ratios. These ratios help predict the possible amount of earnings in the investment. The earnings of the investors can be through higher stock value or dividends. Earnings per share is equals to net income divided by total number of the outstanding share. Dividend yield equals to total dividend payments paid per year divided by market price of the stock. Market value per share is equals to total market value of the shares divided by the total number of the outstanding share. For example, net income is 200,000, outstanding shares is 100,000, dividends 50,000, market price per share 10, total market value shares is 1 million. So, earnings per share is equals to 200,000 divided by 100,000 equals 2 pesos per share. Dividend yield equals to 50,000 divided by 10 times 100,000 equals to 0.5 or 5%. Market value per share is equals to 1 million divided by 100,000 equals 10, meaning each share earns 2 pesos and gives 5% return through dividend. We will come now to the limitation of financial ratio analysis. Financial ratio are the effective tools to measure the status of business, but these have the limitation and potential problems because each firm is independent of the other. The comparison between competitors and even with industry standard may be difficult because of some glaring differences in the operation. So financial ratios help assess a business's health, but they have limits. Different companies operate differently, so comparing their ratios can be misleading. For example, Company A, a luxury car maker, and Company B, a budget car maker, may have very different profit margins. Comparing them using financial ratios alone might not give a fair view because their business models are not the same.